Hi, I'm Ravi, the training assistant. How can I help you? Training session. Understanding the current silver market surge. On 1. Welcome and set the tone. Hello, everyone. I'm Ravi, and I'm thrilled to have you here today. Our focus for this session is to explore the current dynamics of the silver market, which is experiencing an unprecedented price surge. By the end of our time together, you'll have a clear understanding of the factors driving this surge, the implications for investors, and how to approach this evolving market confidently. Objectives. Understand the key factors contributing to the silver price surge. Analyze the implications of increased trading volume and supply backlogs. Discuss investment strategies in light of the current market conditions. 2. Present step by step. Let's break down the key elements of this surge. A. Price surge overview. As of early 2026, silver has reached $86.15 per ounce, a significant rise from just under $30 in January 2025. Momentum. A notable one-day increase of $500, 6.63%, was recorded in mid-January 2026. B. Trading activity. There's been a massive increase in trading volume at local coin shops, with one dealer reporting purchases of $500,000 worth of precious metals in a single day. C. Supply issues. Demand is exceeding supply, leading to delivery delays of 5 to 6 weeks for new physical silver products. D. Gold to silver ratio. The gold to silver ratio has decreased to around 46:1, prompting seasoned investors to consider trading silver for gold. E. Investment dynamics. Long-term holders are experiencing significant returns, while new investors are entering the market due to heightened interest. 3. Simplify and clarify. Let's unpack these concepts a bit more. Why is silver surging? The surge reflects a combination of investor interest in tangible assets as the value of the fiat dollar declines, making silver an attractive option for wealth preservation. What does real price mean? The term real price refers to the retail value of silver, which may exceed the spot price due to high demand and limited supply. 4. Encourage active participation. Now, I'd love to hear your thoughts. What are your initial reactions to the rapid price increase? Has anyone here considered investing in silver recently? Feel free to share your experiences or thoughts on how these market changes might affect your investment strategy.
Ladies and gentlemen, it is 4:23 a.m. on January 12th, 2026. I've been awake for the last 6 hours reading and rereading a 287-page document that was published by the Bank for International Settlements on January 9th at 6 p.m. Geneva time. A document that has received almost zero coverage in the mainstream financial media, despite being the most significant regulatory change to the global banking system since the 2008 financial crisis. A document that goes into full effect tomorrow morning, Monday, January 13th, 2026. That's less than 24 hours from now. The Basel III endgame rules are official. They are implemented. They are binding on every major bank in the world. And what these rules do, what they mandate, what they force banks to do starting tomorrow at market open, is going to fundamentally transform the precious metals market. Because these rules do something that has not happened in 53 years, since Richard Nixon closed the gold window in 1971. These rules remonetize gold and silver. They transform precious metals from speculative commodities into tier 1 banking assets, equivalent to cash and government bonds. And the implications, the consequences, the cascading effects that are going to ripple through the financial system starting tomorrow morning, they are going to change everything. They are going to force banks to buy billions of dollars worth of physical gold and silver to comply with the new capital requirements. They are going to make naked short selling of precious metals economically impossible. They are going to trigger the unwinding of decades of paper market manipulation. They are going to send the price of silver to levels that most people think are impossible. I'm going to walk you through this document line by line. I'm going to show you the specific regulatory changes that go into effect tomorrow. I'm going to show you what banks are being forced to do. I'm going to show you the timeline for compliance. I'm going to show you the math on how much physical metal banks need to acquire. And I'm going to show you why this regulatory change, not speculation, not industrial demand, not geopolitics, this regulatory change is the single most bullish catalyst for precious metals in the last 50 years. But first, I need to explain what Basel III is and why this matters. Because if you don't understand the regulatory framework, if you don't understand how banks are capitalized, if you don't understand what tier 1 assets are and why they matter, you won't grasp the magnitude of what's happening tomorrow. The Bank for International Settlements, the BIS, is the central bank of central banks. It's based in Basel, Switzerland, Every major central bank in the world is a member. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the People's Bank of China. They all answer to the BIS. And the BIS sets the global banking standards that every bank must follow. After the 2008 financial crisis, when Lehman Brothers collapsed and the global banking system nearly imploded, the BIS realized that banks were overleveraged. They had too much risk. They didn't have enough capital to absorb losses. So the BIS created a new set of rules called Basel III. These rules mandate how much capital banks must hold relative to their assets. They define what counts as high quality capital and what counts as risky assets. Basel III has been rolled out in phases over the last 15 years. Basel III, Phase 1, was implemented in 2013, Phase 2 in 2019, and now in January 2026, we're getting the final phase. Basel III, Endgame, the rules that complete the framework, the rules that close the loopholes, the rules that fundamentally change how precious metals are treated. Now, let me show you the specific changes. I'm going to read directly from the BIS document, Section 4.7, Treatment of Precious Metals in Capital Adequacy Calculations. Effective January 13th, 2026, physical gold and silver held in allocated segregated form shall be classified as Tier 1 assets for purposes of calculating common equity Tier 1 capital ratios. Physical precious metals meeting the following criteria shall receive a 0% risk weighting. A, minimum purity of 99.5% for gold, 99.9% for silver. B, stored in approved vaults with full title transfer. C, audited annually by independent third parties. D, fully allocated to the bank with no encumbrances or third-party claims. Let me translate that from regulatory speak into English. Starting tomorrow, if a bank owns physical gold or physical silver that is stored in a vault, that is audited, that is fully allocated with clear title, that metal counts as Tier 1 capital. It's treated the same as cash. It's treated the same as U.S. Treasury bonds. It strengthens the bank's balance sheet. It improves their capital ratios. It reduces their regulatory burden. This is massive. Because until now, gold and silver were classified as risk assets. They were treated like stocks or corporate bonds. They had a 50% risk weighting, which meant that if a bank held $100 million of gold, it only counted as $50 million of capital for regulatory purposes. And because of that unfavorable treatment, banks had no incentive to hold physical precious metals. It was capital inefficient. It was a waste of balance sheet space. But tomorrow that changes. Physical gold and silver get a 0% risk weighting. If a bank holds $100 million of physical metal, it counts as $100 million of Tier 1 capital. It's capital efficient. It strengthens the balance sheet. It helps the bank meet regulatory requirements. So banks are going to want to hold physical precious metals, not because they're speculating on price, not because they think gold and silver are going up, but because holding physical metal improves their regulatory ratios and reduces their capital requirements. But here's where it gets even more significant. Let me show you Section 4.8, Treatment of Unallocated and Paper Precious Metal Positions. Unallocated precious metal positions, including but not limited to forwards, swaps, options, and ETF holdings not backed by segregated physical metal, shall be classified as derivative exposures, subject to the credit valuation adjustment framework. Such positions shall carry a minimum risk weighting of 85% and shall be subject to net stable funding ratio requirements with an available stable funding factor of 50% and a required stable funding factor of 100%. Let me translate this one too, because it's critical. Starting tomorrow, if a bank holds paper gold or paper silver, if they have positions in gold futures, silver forwards, unallocated precious metal accounts, any position that is not fully backed by physical metal in a vault, those positions are treated as high-risk derivatives. They get an 85% risk weighting, and they require twice as much stable funding as they provide. What does that mean in practice? It means paper precious metal positions are capital intensive. They're expensive to hold. They penalize the bank's balance sheet. They make it harder to meet regulatory requirements. So banks are being given a choice: hold physical metal and get favorable regulatory treatment, or hold paper metal and get punished. The incentive structure has completely flipped. And here's the part that's going to blow up the silver market. Section 4.9, Treatment of Short Positions in Precious Metals. Short positions in precious metals, whether outright or synthetic, shall be subject to a capital conservation buffer requirement of 2.5% in addition to standard risk weightings. Banks maintaining net short exposure in precious metals exceeding 5% of total assets must hold additional Tier 1 capital, equal to 10% of the notional short position value. Failure to maintain adequate capital buffers may result in restrictions on dividend distributions and discretionary bonus payments. Do you see what that says? Starting tomorrow, if a bank is short gold or silver, if they've sold precious metals they don't own, they have to hold additional capital against that position. A lot of additional capital. And if they don't, the regulators can restrict their ability to pay dividends to shareholders and bonuses to executives. This makes naked short selling of precious metals economically unviable because the capital requirements are so onerous that the cost of maintaining the short position exceeds any profit the bank could make from that position. Let me show you the math. Let's say a bank is short 100 million ounces of silver. At $80 per ounce, that's a notional value of $8 billion. Under the new rules, the bank needs to hold Tier 1 capital equal to 10% of that notional value. That's $800 million of capital tied up just to maintain that short position. But Tier 1 capital is expensive. It's equity, it's shareholder money, and shareholders expect a return. If the bank is tying up $800 million of capital to maintain a short position that might generate a few $1,000,000 of trading profit per year, that's a terrible return on equity. It's single-digit percentage returns. Shareholders will revolt. So what does the bank do? They cover the short. They buy back the position. They eliminate the short exposure to free up that capital for more productive uses. And this is happening right now. This is happening in the 48 hours before the rules go into effect. Banks are scrambling to close their short positions in gold and silver before Monday morning when the capital requirements kick in. Let me show you the evidence. The COMEX silver open interest, the number of outstanding contracts, has dropped by 47,000 contracts since January 6th. That's 235 million ounces of paper silver that has been closed out in 1 week. Why? Because the banks that are short are covering. They're buying back their shorts before the rules change. The gold open interest on COMEX has dropped by 180,000 contracts since January 6th. That's 18 million ounces of gold. Again, shorts covering before the deadline. And this is just the beginning because many banks haven't moved yet. Many banks are waiting until the last minute, hoping they can cover at favorable prices. But there's a problem. When everyone tries to cover at the same time, when all the shorts rush for the exit simultaneously, the price doesn't just go up, it explodes. This is called a short squeeze. And it's not driven by speculation. It's not driven by retail investors. It's driven by regulatory compliance. Banks have no choice. They have to cover or face massive capital requirements and regulatory penalties. Now let me show you the timeline for compliance, because the rules go into effect tomorrow, but banks have a transition period to fully comply. From the document, section 11.3, transition and implementation schedule, banks shall have until March 31st, 2026 to achieve full compliance with the Tier 1 capital requirements for precious metals holdings. During the transition period, banks must demonstrate reasonable progress toward compliance and submit monthly progress reports to their primary regulator. Failure to achieve at least 60% compliance by February 15th, 2026 may result in enhanced supervisory scrutiny and restrictions on capital distributions. So banks have until March 31st to get into full compliance, but they need to show progress. They need to be at 60% compliance by February 15th, which is 34 days from now, and they need to be at 100% compliance by March 31st, which is 78 days from now. What does this mean? It means banks have 78 days to acquire enough physical gold and silver to back their positions or close their positions entirely. And given how tight the physical market already is, given the supply constraints we've been discussing in previous videos, there is no way the banks can acquire that much physical metal without driving prices significantly higher. Let me show you the math on how much metal needs to be acquired. According to the most recent Bank for International Settlements data, the global banking system holds approximately $680 billion in unallocated gold positions and $94 billion in unallocated silver positions. These are positions that are not backed by physical metal. These are paper claims, IOUs, fractional reserve positions. Under the new rules, these positions either need to be backed by physical metal or closed. Let's assume that 70% of these positions get closed and 30% get converted to physical. That means banks need to acquire physical metal to back $204 billion of gold positions and $28 billion of silver positions. At current prices, $204 billion of gold at $2,116 per ounce is 96 million ounces. At current prices, $28 billion of silver at $80 per ounce is 350 million ounces. Now here's the problem. Global gold mine production is 110 million ounces per year. That's 9 million ounces per month. So the amount of gold that banks need to acquire, 96 million ounces, is equal to nearly 11 months of global mine production. Global silver mine production is 827 million ounces per year. That's 69 million ounces per month. The amount of silver that banks need to acquire, 350 million ounces, is equal to 5 months of global mine production. But banks can't just buy mine production. The mines are selling their output to industrial users, to mints, to existing contracts. The amount of silver available for banks to purchase from the market is maybe 10 to 20 million ounces per month from recycling and investment disinvestment. So banks need 350 million ounces. The market can provide maybe 20 million ounces per month. Over 78 days, that's 52 million ounces. Banks need 350 million. The market can provide 52 million. There's a shortfall of 298 million ounces. How does that shortfall get resolved? The price rises. The price rises until holders are willing to sell. The price rises until industrial users reduce consumption. The price rises until equilibrium is restored. And how high does the price need to go? Historically, when there's a structural shortage, when demand exceeds available supply by this magnitude, prices can rise 50% to 100% or more until the shortage is resolved. Silver at $80 going up 50% takes us to $120. Going up 100% takes us to $160. And that's just to resolve the bank buying driven by regulatory compliance. That doesn't include industrial demand, BRICS accumulation, geopolitical safe haven buying, or any other factors. The Basel III endgame rules are forcing banks to buy 350 million ounces of physical silver in the next 78 days in a market that can only provide 52 million ounces. The math doesn't work. The only solution is a massive price increase. Now let me show you the implications for paper precious metal accounts. Because if you hold gold or silver in an unallocated account, if you have a position with a bank where they owe you metal, but they don't have it segregated in your name, you are at serious risk. From section 6.4, customer unallocated precious metal accounts. Banks offering unallocated precious metal accounts to retail and institutional clients must notify account holders within 30 days of these regulatory changes and provide options for A, conversion to allocated accounts with full segregation and storage fees, B, liquidation to cash at prevailing market prices, or C, rollover into bank-issued precious metal-backed debt securities subject to credit risk of the issuing bank. Translation: if you have an unallocated gold or silver account, the bank is going to contact you in the next 30 days. They're going to say, we can no longer offer unallocated accounts because the regulatory costs are too high. You have three options. One, convert to allocated, where we actually hold physical metal in your name and you pay storage fees. Two, we close your account and give you cash. Three, we convert your metal claim into a bond that we issue and you become a creditor of the bank instead of an owner of metal. Option one is good if you want to keep metal exposure, but the fees are going to be high because the bank has to acquire physical metal, store it, insure it, audit it. Option two means you lose your metal exposure and you're holding cash in a depreciating currency. Option three is terrible because you're taking credit risk on the bank. If the bank fails, you're an unsecured creditor. You might get nothing. So if you hold unallocated precious metal accounts, you need to make a decision in the next 30 days. Now, my strong recommendation is option one, convert to allocated, pay the fees. Because having physical metal in your name in a vault is infinitely better than having a paper claim that might not be honored. And here's the thing, millions of investors around the world
Welcome to the Deep Dive. Today we are opening a stack of sources that describe a sudden and pretty seismic regulatory shift.
It's a quiet transformation, that's for sure.
Exactly. It had almost zero attention from major financial news, and yet these new rules literally just went into effect a few hours ago.
Yeah.
We're looking at a 287-page document that the Bank for International Settlements, the BIS, published just this past Friday, January 9th.
And that Friday document, it's not just another paper, it's the grand finale of this massive multi-year overhaul.
The Basel III Endgame.
That's the one. And you're right, the effective date is today, Monday, January 13th, 2026. So to call this a small tweak would be a vast understatement.
Right.
I mean, this is arguably the most radical, comprehensive, and just consequential regulatory change we've seen imposed on the global banking system since right after the 2008 financial crisis.
And the central impact, the big one that's going to change everything from how a major bank structures its balance sheet to how you should be thinking about your own savings, is the mandatory remonetization of physical gold and silver.
That's the term. They're being structurally and, legally reclassified.
Moving from what? Speculative commodities.
Exactly. From risky speculative things into the elite category of tier one banking assets. And this isn't some theory, it's a mandatory capital requirement.
This is a truly historic moment then.
It really is. We are literally watching the reversal of 53 years of entrenched financial doctrine.
53 years.
Yeah. The last time hard assets held this specific elevated monetary status was before President Nixon closed the gold window back in 1971. The incentives that pushed banks towards paper for 5 decades they've completely flipped almost overnight.
Okay, so our mission for this deep dive is pretty clear, but it's urgent. We need to unpack the specifics of these Basel III endgame rules, show you the exact sections where this is all written down.
And we have to apply the math.
Right. Apply the math to the physical metals market to really understand the demand shock that's already happening. Then we'll look at what you, the listener, need to do right now, especially if you have paper metals in an unallocated account.
And that's critical.
And finally, we're going to look at how these cutting-edge decentralized platforms, specifically JusticeFund Exchange and Secure Bank Bucks, are being designed to handle this new reality of high-value transactions and commercial claims in this completely new regulatory landscape.
Before we get into the dense regulatory language, let's just make one thing crystal clear.
Go ahead.
The massive market force we're about to describe, it's not being driven by inflation fears or geopolitics or retail speculation. I mean, those things are there, of course.
Sure, they're in the background.
But this is a regulatory-driven force. It is mandatory. It's binding. And it applies to every major bank on the globe. So our analysis has to focus on how this shift reduces systemic risk.
By forcing them to hold real assets over just paper claims.
Exactly. And what that means for the future of banking workflows and asset security. So let's unpack this quiet revolution.
Okay, let's start at the very top with the authority itself. We hear the term BIS thrown around, but who exactly is the Bank for International Settlements? Why does a document they drop on a Friday have this immediate mandatory force everywhere?
The BIS.
Yeah.
Well, it's arguably the most powerful yet least known financial institution on the entire planet.
That's a big claim.
It is, but it's true. It's widely called the central bank of central banks. It's based in Basel, Switzerland, and its main job is to, foster cooperation and act as a bank for central banks. But the key thing is it sets the mandatory global banking standards.
So when the BIS issues a mandate, who's on the hook? Who has to listen?
Everyone. Every major central bank in the world is a member and critically agrees to follow the framework. That's the U.S. Federal Reserve, the European Central Bank, Bank of England, Bank of Japan, the People's Bank of China. All of them.
So a rule from the BIS just flows downhill.
Immediately. If the BIS sets a capital requirement, it flows straight into the national regulations that govern every single commercial bank in those countries. These rules are absolutely binding.
And the Basel framework, that's their standards for capital adequacy. Basically making sure banks don't blow up by telling them how much capital to hold against their risky assets.
Precisely. Basel III was born directly out of the failures we all saw in the 2008 crisis. I mean, think about Lehman Brothers.
Of course.
The big lesson was that banks were just critically over-leveraged. They were holding all these complex, opaque, super risky assets, but they didn't have enough high-quality capital to absorb the losses when the housing bubble popped. Basel III was designed to force them to hold way more capital and to strictly define what's high quality, the tier one assets, versus what's just risky junk.
And this hasn't been a sudden thing. This has been rolling out for years, right?
Oh, yeah. It's been a very long phased implementation to give the financial sector time to adapt. Phase one was way back in 2013, then phase two in 2019. But today, January 2026, this is it. This is the Basel III endgame.
The final step.
The final step. It completes the whole framework, tightens every screw, and crucially, closes these long-standing loopholes that let banks leverage the paper gold and silver markets while still getting favorable treatment for it.
Okay, let's get into the core change, the revolutionary new status of physical precious metals. We're looking at section 4.7 of this BIS document. What are gold and silver now, and why is that 0% risk weighting so powerful?
Well, effective immediately, physical gold and physical silver, and this is key, provided they are held in a very specific, secure way, are officially classified as tier one assets.
Tier one.
Tier one. for calculating common equity tier 1 or CET1 capital ratios, this is the absolute bedrock of a bank's financial stability. We've just upgraded them from speculative toys to what the global regulator sees as effectively near cash.
So that's the remonetization, a reversal of 53 years of policy.
Right.
But let's clarify that risk weighting.
This is the absolute crux of the incentive flip. Until yesterday, gold and silver were treated as risk assets. They had a 50% risk weighting, meaning if a bank held, say, $100 million worth of gold, it only counted as $50 million of usable regulatory capital.
So it was inefficient.
Very inefficient, capital inefficient, unattractive. It just ate up their regulatory burden without giving full credit. But under these new rules, allocated physical metals get a 0% risk weighting.
Wow.
So that same $100 million in physical gold now counts as a full $100 million of pure, high-quality Tier 1 capital.
So a bank's capital adequacy just instantly improves, dollar for dollar, if they hold the physical metal.
It's a fundamental change in the math. It's a profound difference. Holding physical metal strengthens the balance sheet, improves their capital ratios, and it lowers their overall regulatory burden and their cost of funding. They are now actively incentivized, for pure compliance reasons, to hold physical metal.
But the sources stress this isn't automatic. To get that amazing 0% risk weighting, the metal has to meet some incredibly strict criteria. Walk us through those 4 requirements.
Yeah, these are the BIS's way of making sure the asset is really, truly high quality, fully owned, and auditable. The 4 criteria are non-negotiable.
Okay.
First, purity. It's got to be 99.5% for gold and even higher, 99.9% for silver. Standardized quality.
Makes sense.
Second, storage. It has to be stored in approved high security vaults, and the bank must have full title transfer docs. No fractional claims.
No IOUs.
None. Third, it has to be audited annually by independent third parties, an external check. And fourth, and this is crucial, allocation. The metal must be fully allocated to the bank.
Meaning no other claims on it.
No encumbrances, no lands, no third-party claims at all. It is segregated, it is owned, and it is fully accounted for.
That level of segregation and third-party audit is huge. The BIS is demanding proof of physical existence and clear ownership before they grant that Tier 1 status.
Precisely. The burden of proof is now on the bank to show absolute physical control. And, that brings us to the flip side of the coin, the massive paper market.
Let's talk about Section 4.8, the paper penalty. How is Basel III Endgame treating all the unallocated positions, the forwards, the swaps, the paper gold and paper silver that have dominated the market for so long?
This is where the incentive flip becomes an outright regulatory punishment.
Okay.
Unallocated precious metal positions, so forwards, swaps, options, and critically any ETF that's not backed by segregated physical metal, they're now classified as high-risk derivative exposure.
High risk.
And they get subjected to the punishing credit valuation adjustment, or CVA, framework.
CVA framework. Okay, break that down for us. What is CVA in simple terms?
Think of CVA as the capital a bank has to hold just in case its trading partner, the person on the other side of that paper contract, goes bust and can't pay up.
A default risk.
Exactly. Before, that risk was often kind of ignored or treated very lightly. Now the BIS is saying that paper claim is fragile and you must set aside a chunk of capital just in case the other party fails.
And what's the capital cost for holding that fragile paper?
These paper positions now carry a minimum risk weighting of 85%.
85.
85%. Compare that to the 0 for physical. So if a bank holds $100 million in paper claims, they now have to set aside $85 million in capital. It's incredibly expensive. But wait, it gets worse.
Of course it does.
They're also subject to the net stable funding ratio, or NSFR, requirements.
All right, let's break down NSFR.
Yeah.
That's even more abstract than CVA.
NSFR is all about making sure banks fund their long-term assets with stable, long-term money, not flighty, short-term cash that can disappear overnight. And the rules here are the hammer.
Okay.
These paper claims have an available stable funding factor of 50%. That means you only get credit for half the funding you actually have. At the same time, they have a required stable funding factor of 100%.
So you have to fund the full value of the claim.
Right.
So if I'm getting the mechanics right, the rule is saying we only trust half of your funding, but we demand you collateralize the full risk.
You got it. It's a double penalty, a high risk weighting of 85%, and these punching funding requirements. To put it simply, holding paper or unallocated metal is now just prohibitively expensive. It actively hurts the bank's balance sheet. It's a complete, absolute flip in the incentive structure.
So the banks are being forced into a choice. Either you absorb this massive capital penalty for holding paper, or you free up that capital by getting into physical assets.
That's the strategic decision B3E is forcing on them. And that brings us to the most direct attack on market manipulation we've seen. Section 4.9, which goes right after short positions in precious metals.
This section, from what I'm reading, basically makes the old practice of naked short selling, selling metal you don't own and will never deliver, financially suicidal for the banks.
It does. Short positions, whether they're outright sales or synthetic derivatives, get hit with two penalties now. First, there's a capital conservation buffer of 2.5% on top of everything else. But the real hammer blow is for the banks that are aggressively short.
And there's a specific threshold for that, right?
Yeah, correct. If a bank has a net short exposure in precious metals that's more than 5% of their total assets, they face this crippling new requirement. They have to hold additional Tier 1 capital equal to 10% of the notional value of that short position.
And that's capital they can't use for anything else.
It's just frozen, tied up.
Let's use the example from the sources to show just how absurd it is to maintain these positions now, especially for silver.
Okay, so imagine a big commercial bank. They have a huge silver short. Let's say they're short 100 million ounces. If silver is priced at, let's say, $80 an ounce, the total value of that short is $8 billion.
A huge position.
Huge. Under Section 4.9, that bank is immediately forced to tie up $800 million of pure, expensive Tier 1 equity, their shareholders' capital, just to maintain that short.
A stunning cost. That $800 million could be out there, making loans, generating returns for shareholders.
Exactly. The return on equity, the ROE for that $8 billion short position just collapses. Shareholders demand a high ROE. And if this short only makes a few million a year in trading profit, the ROE plummets to maybe 1 or 2%. The cost of compliance, the audit, tying up all that capital, it just completely outweighs any possible profit. This one rule makes naked short selling economically unviable. It mandates a cover.
And we don't have to guess if this is working. We're seeing it in the market data right now in the days leading up to this deadline.
We are. The data confirms the exodus. The COMEX Silver Open Interest, that's the measure of outstanding paper contracts. It's dropped by 47,000 contracts since January 6th.
Which is how much silver?
That's the equivalent of 235 million ounces of paper silver that's been closed out, bought back, and just vanished from the market in 1 week.
And gold.
Same story. Gold open interest is down 180,000 contracts. That's 10 million ounces of paper gold closed out.
So the story isn't that banks suddenly think the price is going up.
Yeah.
It's that the regulator has made not covering financially toxic. They have to cover to free up those hundreds of millions in Tier 1 capital.
The motivation is purely regulatory compliance and their fiduciary duty to their shareholders, which, sets the stage for the next logical step. The physical scramble.
This mandatory action sets up a physical demand shock unlike anything we've seen in decades. The rules are live today, but the banks are on a ticking clock to get fully compliant.
And that timeline is what creates the real urgency. We have to look at the deadline in Section 11.3 because that dictates the pace of all this mandatory buying.
So banks have until March 31st, 2026 to be fully compliant. That's 78 days from today?
78 days to either close out or physically back all those paper positions. But the clock is actually even tighter than that.
How so?
There's a crucial interim checkpoint. Banks have to show reasonable progress and hit at least 60% compliance by February 15th.
February 15th. Oh. That's just 34 days away.
34 days. And if they miss that 60% mark, they face serious supervisory consequences. We're talking enhanced scrutiny, restrictions on capital distributions.
Meaning they can't pay shareholder dividends or executive bonuses.
That's the stick. So this is not a leisurely 78-day plan. It's a 34-day emergency sprint driven by the need to protect dividends. This guarantees immediate heavy buying and short covering.
Absolutely. So the question becomes, how much physical metal do they actually have to buy?
We can quantify this. We can use the BIS's own data on the scale of these unallocated paper positions globally.
And what are those starting numbers?
The sources cite about $680 billion in unallocated gold positions and $94 billion in unallocated silver positions across the global system.
Now remember, these are the paper claims, the IOUs, that are now toxic because of that 85% risk weighting.
Right. They have to be closed out or physically back to get that sweet 0% weighting.
The sources modeled a pretty useful conversion scenario. They assume banks close out 70% of these positions by just buying back the paper, which we're seeing. But they still need to convert the remaining 30% to physical metal.
And that's a conservative assumption. So based on that 70-30 split, banks need to acquire physical metal to collateralize about $204 billion worth of gold positions and $28 billion worth of silver.
And in ounces, what does that look like?
Using the price benchmarks in the source material, so $2,016 for gold and a projected $80 for silver.
96 million ounces of gold and 350 million ounces of silver.
No. Now we have to crash that mandatory demand against the harsh reality of global supply. And this is where the math just breaks. It mandates a price explosion.
Let's start with gold.
Global gold mine production is about 110 million ounces a year. So the 96 million ounces of mandatory bank demand is nearly 11 months of total global mine production.
All crammed into a 78-day window.
All crammed into 78 days. Gold demand is high, but the silver situation, based on these numbers, it looks impossible.
How so?
It is catastrophic for the current valuation of the paper market. Global silver mine production is about 827 million ounces a year. That's roughly 69 million ounces a month. The 350 million ounces of mandatory demand is equivalent to 5 months of global mine production.
But the banks can't just buy up 5 months of production. That silver is already spoken for, right? For industrial uses, solar panels, electronics.
Exactly. That demand is huge and it's inelastic. When we factor in the existing industrial contracts, mint demands, and other investment flows, the available market supply for banks to buy from recycling and things like that is estimated at only 10 to 20 million ounces per month.
So even if we're generous and take the high end of that, 20 million a month.
Over the 78 days they have, the market can only realistically provide about 52 million ounces of silver.
Let me just repeat that gap for everyone. Banks need 350 million ounces of silver, mandated by regulation, within 78 days. The available supply is, at most, 52 million ounces.
Which means there is a guaranteed shortfall of 298 million ounces of silver that must be acquired in this short period.
And you can't just close paper positions to fix this. That just fixes the bank's regulatory problem. It doesn't create the physical metal.
Exactly. The shortfall must be resolved by a massive structural price increase.
The price has to rise high enough to do two things. One, get current holders to sell and take profits. And two, force industrial users to cut back because it's just too expensive.
That is the only way to find equilibrium. And historically, we know what this kind of supply-demand shock does to prices. When you have a demand that is 6 times the available supply over a short period, prices don't move in a straight line.
So what are the price implications from the source material?
Historically, shortages of this magnitude lead to rapid price appreciation. We're talking 50 to 100% or more just to get the demand reduction and selling you need.
So if silver's around $80 now,
a 50% rise takes you to $120. 100% rise takes you to $160. And remember, this entire move is driven purely by mandatory bank buying to meet a deadline. It's not general inflation or investor sentiment.
And this is all happening against a backdrop of some powerful, accelerating macro tailwinds. It's like a perfect storm.
That's the critical context. This isn't happening in a vacuum. It's colliding with these huge global forces, rising geopolitical risk, the Iran crisis, the potential launch of a BRICS currency challenging the dollar, and a Federal Reserve that is completely trapped.
Trapped between fighting inflation and causing a deep recession.
Right. They fight inflation, they risk recession, they try to avoid recession, inflation comes back. This whole combination pushes the global economy toward a stagflationary environment.
Which is?
It's the worst possible environment for traditional financial assets like stocks and bonds. They get hammered from both sides, but it is historically the absolute best environment for hard assets, for commodities, and specifically for precious metals.
So the B3E rules are forcing the global financial system to move capital into the very assets that the macro picture says are the most valuable right now.
It's a perfect convergence.
Okay, given this immediate regulatory scramble, we need to shift to actionable strategy for the listener. The most urgent risk is for the huge number of people holding paper precious metals. Let's focus on the crisis facing unallocated account holders, detailed in section 6.4 of these rules.
Right. If you, the listener, hold gold or silver in an unallocated account, and that means the bank owes you the metal, but they're using the physical bars for their own purposes on a fractional basis, you are now holding a highly risky liability for that bank.
And immediate action is needed.
Absolutely. The B3E rule says banks have to notify you of your account's new high-risk status within 30 days.
And when that letter arrives, it's not going to be good news. The banks will give you 3 options, and none of them are great for you.
That's right. The options will be, number 1, conversion to an allocated account. This sounds good, but it means the bank has to go buy physical metal and segregate it for you. And they will pass on the soaring costs of acquisition, storage, insurance, and auditing to you through very high fees.
What's option 2?
Liquidation to cash. The bank just closes your account and gives you cash at the market price. This is terrible because you lose all exposure to the asset that's about to see this mandatory price explosion, and you're left holding cash in a depreciating currency.
And the third option?
The third, and arguably the worst, is rollover into bank-issued precious metal-backed debt securities. This completely changes your status. You're no longer a claimant on a tangible asset. You're just an unsecured creditor of the bank.
So if the bank fails in the next crisis,
You're in line with all the other unsecured creditors and you could lose everything.
so the bank needs you to make a choice that helps them, not necessarily you. The takeaway here is you can't just wait for the letter.
No. Action 1 is to contact your bank now. Call your wealth manager, send an email, formally ask about their plans for unallocated accounts because of Basel III. You need to push hard for option 1, conversion to allocated, or demand physical delivery.
Before the panic starts.
Before the mass liquidation and conversion panic starts, exactly. Get ahead of the curve.
Beyond the unallocated accounts, we need to talk strategy for those who already have physical metal or want to get it. The sources note the huge gains we saw last year, 35% for gold, 140% for silver in 2025, and how that kind of return just warps your thinking.
High returns change behavior. They increase risk because people get complacent. The source material really stresses defining your purpose. Are you holding metals as long-term savings, or is this a high-growth trade? You have to, as the document says, know the dog's name to call it home.
And how should that definition drive your choice between, say, gold and silver?
Well, gold is the long-term savings vehicle. It's the ultimate preservation of purchasing power. Its price moves are usually slower, more measured. Silver, on the other hand, is a high-growth trade. It's way more volatile, and its market is small enough that this mandatory short squeeze could drive just violent, rapid gains.
So long-term wealth preservation, gold is the foundation.
Right. If your goal is to capitalize on a short-term price spike driven by regulation, silver is your instrument.
And the biggest risk isn't that the rally stops, but that the gains make people forget they need a workable exit plan, especially with physical assets.
That's the risk of complacency. If you're a saver, you just keep consistently buying, dollar cost averaging. But in a period where we expect these huge regulatory-driven gains, the plan has to evolve. You have to pay much more attention to price drops to control your cost basis.
And there's a very near-term timing opportunity here based on something else entirely.
Yes, this is a bit counterintuitive. Every January, big commodity indexes have to rebalance their portfolios. After a year like 2025, where gold was up 65%, these funds are way overweight in gold and silver.
So they're forced to sell.
They are forced to sell, not because the fundamentals are bad, but because an algorithm says they have to get back to a specific allocation percentage.
And this is happening right now.
Right now. Between January 9th and the 15th, this mandated selling can create a short-term buying dip, a moment of weakness that has nothing to do with the long-term Basel III trend. For a savvy buyer, that's your chance to control your cost basis before the real B3E buying overwhelms the market.
Okay, let's talk practically about the exit strategy. The sources are clear. Physical metal is an awkward, slower trade than a paper contract. Buying the right thing now saves you huge headaches and lost profit later.
This is a veteran insight that new buyers always miss. When the market is moving fast and you want to lock in a profit, you don't want friction. You need to buy the coins of the realm, the most popular, recognizable bullion in your area. In the US, that's American silver eagles, gold buffaloes.
The anecdote in the sources about local dealers really illustrates this silver dilemma between generic and premium products.
It was striking. The sources talked to local coin shops just this week, and the form of the silver completely changed their willingness to buy and the price they'd offer. For generic silver rounds or bars, 2 out of 3 shops either said no or offered a buyback price $10 or $11 below the bar.
That's a huge loss of profit.
Huge. But by contrast, those same dealers were all happy to buy American silver eagles. The buyback offers for the official government coins were consistently much tighter, maybe $3 under spot, or even spot price for a regular client.
So the takeaway is the small premium you pay upfront for an official coin is often completely worth it when you go to sell.
It's often surpassed by the difference in the buy to sell spread. So if you're treating silver as a trade to profit from this scramble, you absolutely must buy the easiest form to sell quickly. That means American silver eagles in mint tubes. It maximizes your options for fast liquidation.
Holding generic bars means you might have to wait longer and accept a much lower price when you exit.
The whole strategy is about preparation and precision. If you're new to this, don't let the high prices make you complacent. Build relationships with dealers, understand storage, and figure out your ideal sell price before you ever need to sell. But for the long-term saver, just remember that consistent, disciplined purchase is still likely the best hedge against the very instability B3E is designed to fix.
We've established that these Basel III rules are forcing a total institutional focus on verifiable, secure, and allocated assets. This mandatory physical world has to be putting immense pressure on the old financial and legal infrastructure.
Immense pressure. The shift to requiring auditable segregated assets and the penalties for paper claims, it just exposes how clunky, slow, and opaque the traditional commercial legal workflows really are.
Which means you need something new.
You need new platforms that use decentralized infrastructure to manage everything from a simple transaction to a complex commercial claim, but with better security and seamless compliance.
So let's start with the Justice Fund Exchange, or JFE. It's described as this transformative digital nexus for things like judgment fund claims and bills of exchange. How does it tackle that old world complexity?
JFE is built to be the digital engine for commercial law. The transformative part is its foundation, which is powered by Notary Chain. It integrates blockchain, smart contracts, and decentralized notarization to, automate, authenticate, and secure these instruments that have always been paper heavy and high risk.
So it's taking things like trust administration and commercial claims, which are slow and prone to disputes, and putting them on an immutable, auditable ledger.
Precisely. The system uses tokenization, creating a digital version of a real-world asset or claim, and it sticks closely to established legal principles, specifically the Uniform Commercial Code, or UCC. The whole goal is to manage claims and assets with way more transparency and efficiency, making them easily verifiable for institutions that now have to meet B3E's strict audit rules.
Let's make that connection to B3E really concrete. Basel III demands strict auditing and full allocation. How does JFE help a stakeholder meet those rules, maybe using something like UCC Article 9?
JFE is, at its heart, a compliance tool. UCC Article 9 governs secured transactions using collateral to secure a loan. JFE is designed to help a business or a bank secure valuable assets like, say, tax credits under UCC Article 9 by tokenizing the underlying claim.
Which used to be a mountain of paperwork.
A mountain of paperwork and a centralized system full of potential errors. But with JFE and Notary Chain, by digitizing that claim onto the blockchain, you get the verifiability and the irrefutable time-stamped proof of a line you need for compliance.
So an auditor could just check the chain.
An auditor facing B3E rules needs absolute proof that an asset is unencumbered and allocated. JFE delivers that proof on chain, which eliminates the uncertainty of paper records. It also provides verifiable proof of funds on chain, so a bank can rely on a transaction certainty for their capital planning.
The key innovation seems to be integrating decentralized notarization into the legal process. What does that stop that a traditional notary couldn't?
Well, a traditional notary is a single trusted person who verifies an identity and a signature at one point in time. Decentralized notarization on Notary Chain uses consensus and cryptographic proofs. So when a legal document, like an affidavit, is digitized, it's immediately time-stamped, linked to a verifiable identity, and recorded forever across a decentralized network.
So you can't backdate it, you can't forge it.
You can't backdate it, you can't commit fraud, you can't have competing claims on the same asset. It provides an irrefutable, instantly auditable trail for regulators.
It sounds like JFE is just modernizing the entire life cycle of a commercial instrument, making it faster and more trustworthy for the institutions that now demand verified assets.
Exactly. It's modernizing three key functions: complex commercial banking tasks, trust administration, and even arbitration in legal disputes. By delivering this level of security, privacy, and accountability, JFE is setting a new standard for digital commercial workflows, which aligns perfectly with the B3E demands for transparency.
Now let's shift to Secure Bank Box, or SBB. This platform seems to address the security and logistics challenges that get so much bigger when banks are forced to deal with physical asset management under Basel III.
That's a good way to put it. Secure Bank Box is a platform designed for the financial and logistics industries. If JFE handles the legal and commercial claims security, SBB handles the financial settlement and operational logistics security. It also uses blockchain, smart contracts, and data tokenization to boost security and efficiency in high-volume settings.
In a world with all this geopolitical fragmentation and regulatory shocks, FVB's ability to tokenize financial assets sounds like a crucial risk mitigation tool for cross-border transactions.
It absolutely is. I mean, think about the post B3E world. Banks have to hold and track huge amounts of physical segregated metal. They need robust, secure supply chains and flawless internal systems.
Right.
SBB's tokenization allows them to mitigate the risks of traditional cross-border payment rails and physical asset transfers. By creating a verifiable digital token for a financial asset, it streamlines settlements and ensures security, even if traditional banking relationships break down.
So FVB is basically helping them manage huge volumes of transactions while staying compliant and secure.
That is its core value. It allows stakeholders to navigate these regulatory challenges, like the huge tracking and reporting demands from B3E, by optimizing settlements through a decentralized infrastructure. Like JFE, SBB is critical in managing complex banking tasks, trust administration, and facilitating arbitration. It provides the technological backbone for the security, privacy, and compliance this new banking landscape demands. Both platforms represent the required evolution of commercial systems in a world that now mandates verifiable, allocated, and secure assets.
Okay, let's bring this deep dive to a close. We have covered a massive amount of ground today, tracking a regulatory mandate that, despite having zero mainstream coverage, has structurally changed the global banking landscape overnight.
To recap the sheer magnitude of it, the quiet regulatory upheaval of the Basel III Endgame fundamentally changes the value of physical gold and silver. It's enforcing a massive mandatory shift of capital out of highly penalized paper claims, which now have an 85% risk weight, and into audited, segregated hard assets that now carry that desirable 0% risk weighting.
We quantified the demand: 350 million ounces of silver needed in just 78 days in a market that can only realistically supply maybe 52 million. That makes a mandatory, structurally driven price increase just inevitable. And we looked at the urgency for anyone holding an unallocated metal account to contact their bank immediately and push for physical allocation.
And finally, we looked at the modern digital infrastructure that's evolving to manage this new reality: JusticeFund Exchange and Secure BankBox. These platforms are designed to modernize commercial and legal instruments using decentralized notarization and tokenization, enabling efficiency and ensuring compliance.
Countdown is over. The rules are live as of today, January 13th, 2026, and that critical 78-day compliance clock is ticking until March 31st. This guarantees massive, mandatory institutional demand for physical metal starting now.
And this convergence is the key. The remonetization of physical assets, reversing 53 years of policy, is happening at the exact same time as the digital modernization of legal instruments. We're seeing decentralized tech being used to both enforce and support these established legal and commercial frameworks.
Which brings us to a final provocative thought for you, the listener, to think about as these financial tectonic plates keep shifting. We talked about how JusticeFund Exchange is using decentralized notarization through Notary Chain to manage complex, secured obligations under established legal structures like the Uniform Commercial Code.
The question is this: if the global banking regulator, the BIS, is forcing financial institutions to rely on systems that use irrefutable, decentralized notarization and on-chain proof to be compliant, what does that increasing reliance mean for the future authority of those established frameworks like the UCC?
Are these new platforms just helping the traditional legal system, or are they quietly building a more secure, more accountable parallel system that provides verifiable truth that banks and regulators are now being forced to rely on?
Something to think about as the financial world pivots from trusting paper claims to demanding verified on-chain proof. Thank you for diving deep with us.
Hello, I'm Ravi and I'm a training assistant. How can I help you? Welcome to the Silver Market Training Session. Welcome and set the tone. Hello, everyone. I'm Ravi, your training assistant, and I'm thrilled to have you here today. We are embarking on an exciting journey to explore the recent surge in the silver market. By the end of this session, you'll have a clear understanding of the current market dynamics, the factors driving this price surge, it's on how to navigate this rapidly changing landscape. Learning objectives. 1. Understand the drivers behind the recent surge in silver prices. 2. Analyze the implications of increased trading volume and supply backlogs. 3. Explore strategies for investing in silver amidst market changes. 4. Discuss the impact of the gold to silver ratio on investment decisions. Present step by step. 1. Current market overview. As of early 2026, silver is priced at $86.15 per ounce, a dramatic increase from under $30 in January 2025. Let's visualize this growth with a simple chart showing the price trajectory. 2. Rapid momentum. In mid-January 2026, silver jumped by $5 in a single day, marking a 6.63% gain. Example: if you had invested in silver back in January 2025, your investment would have more than doubled. 3. Massive trading volume. Local coin shops are experiencing unprecedented activity. For instance, one dealer reported buying $500,000 worth of silver in a single day. Visual: a graph showcasing daily trading volumes can help illustrate this point effectively. 4. Supply backlogs. Demand for physical silver has soared, leading to delivery delays of 5 to 6 weeks for new materials. Why? This is due to the overwhelming demand outpacing supply. 5. Gold to silver ratio. The ratio has dropped to around 46:1, prompting seasoned investors to trade silver for gold. How does this affect you? Understanding this ratio can influence your investment strategy. 6. Profit taking versus stacking. Long-term holders are capitalizing on this surge, while new investors are entering the market at these record highs. Discussion point: what strategies do you think are best for new investors entering at these high prices? Simplify and clarify. Let's break down some key concepts. Real price versus spot price. The real price refers to the retail value that consumers pay, which can often be higher than the spot price quoted in markets. Stacking. This term refers to the practice of accumulating physical silver or gold.
There are going to be certain things from time to time that just make life easier. Your gold jumping more than 60% in value in a year, your silver jumping 140%. But there are also double-edged swords, making some things easier and other things harder. Now, I came up training with single-edged swords, so it's an analogy that I'm still coming to grips with, but from what I can tell, you're not supposed to grip the blade at all. Saving in gold or silver can be a little bit of a cheat code. It's a plan with a lot of potential upside and a relatively small amount of downside risk. But the key there is thinking about it as savings. And that's easier said than done. When I spun this channel up in 2020, I felt like we were about to see both the reward and the risk increase. So all of my early videos were really just about demystifying it, making it easier to get in so you could take advantage of the reward, but also avoid some of those common mistakes that could sting you if you ever got out. In other words, just limiting your risk. Now, the risk and the reward have definitely increased. It's an understatement, actually. Just look at the reward part. Both gold and silver are now at all-time highs, with annual gains from 2025 being higher than they've been in 45 years. And this reward is so clear that it buries the idea of risk for some people. But this is actually when the risk is highest, not because the rally is over or soon to be over, but because the rally has been so significant that it's changed how people think of gold and silver. Your behavior shifts, and buying behavior matters way more at these levels. So I want to go back to the fundamentals. I want to talk about both. I want to talk about how to limit risk and how to maximize upside, all without making the most expensive mistakes that people make at the top. We're going to get into all of that in a minute, but first, a quick shout out to channel sponsor Summit Metals. If you're looking to buy gold or silver, they've got you covered. If you're looking to sell your gold or silver, they can help you there too. SummitMetals.com. Now, that was a longer intro than normal. Where's the news about silver and gold going to the moon, right? Well, we're going to cover a little bit of macro news here in a minute that's going to line up with one of the best tips on maximizing your upside. But since we're talking about risk and reward, I just have to say that even though we're looking at a bunch of gold on the desk here, silver has more potential for both upside and risk right now. But my plan is to use precious metals as long-term savings, and really that means it's ultimately a plan built around gold. Now, don't get me wrong, silver is a lot of fun right now, but I don't treat metals as a high growth trade. I treat them as savings, and that means that I'm not trying to maximize every move for some kind of quick profit. I'm trying to take advantage of opportunities when they show up and limit my downside when they don't. So really, this is a good time to remind ourselves of something very important. The current price action is not normal. And the wildest thinking is going to revolve around silver. Wildest meaning people are approaching it far differently than they have in the past, expecting it to perform different than it was in the past, without labeling it any different than they have in the past or shifting the plan. They're just focusing on the reward, forgetting about the risk. The primary risk, of course, is just not having a workable exit plan. But before we get to that, let's focus on the entrance. A major part of my plan has always been to buy consistently, but I haven't been doing that. And that's mostly because I hit a running goal already for how much I felt I needed to have, and also because the price gains have just spiked the value of what I already owned. But also, we just came off a huge year, 65% annual gain for gold, 140% annual gain for silver. Buying consistently into a run like that, it's just not easy. It's actually pretty brutal. And we just haven't seen the kind of significant pullbacks that would have made that any easier. So my purchases have been smaller. They've been fractional coins, or they've been series coins that I know are only going to become more expensive because they're limited release. And if you don't have a plan to flip semi-numismatic coins for profit, that's really the only real benefit to buying a series coin. Just keeps you at it. They more or less force you to buy. And over the long term, I think that's a positive. Now, if you're buying gold or silver as savings, you're not trying to time this single cycle. You're buying through it. Consistent buying is still going to be the core of the plan. Price goes up, price goes down. You buy either way. But when we see big gains like this, the plan needs to change at least a little bit, not necessarily away from consistency, but you need to pay more attention to price drops. It's really one of the only ways that you can help control your cost basis. But like I just said, we haven't seen very many. Now, we could see that change soon because every year commodity indexes rebalance, and that forces these large passive funds to adjust their positions. This year, this could be really significant because after a year of huge gains in gold and silver both, like we just saw, that can mean selling for no reason other than the fact that the fund is now overweight in gold. That's in terms of the fund's desired allocation percentage. So when that happens, you can see short-term pullbacks that really have nothing to do with the long-term trend. And this isn't just theoretical. Citigroup says they haven't seen any outsized flows like this one. Think about it. Gold was up more than 60% last year. Normally, they're rebalancing against something more like 9 to 14%. So in other words, we could be in for a dip. Now, none of this affects the longer term trend. It's really just to say that if you've been hoping for a lower price in your next purchase, or you've been holding off entirely, maybe waiting for a dip, these are the kinds of events that you should be watching. Timing on the liquidation, by the way, it's right now, January 9th through the 15th. And if you're buying to save, there really isn't all that much else to do. Just keep calm, carry on. But one of the things that I've said since the beginning is that buying the right thing to begin with will save you a lot of trouble when you go to sell. Now, I'm showing two things here. I'm showing semi-numismatic series coins and buffaloes. This isn't even about what's best. It's just about what's easiest to sell. And the right way to go here is to buy the most popular option in your area. So the coins of the realm. And if you've ever doubted this, it's just not hard right now to find examples of local shops actually declining to buy certain things. Now, on the upside, there are lots of options today, including selling online to a dealer like Summit Metals, but certain decisions will always give you more options. And nowhere is that more apparent than in the silver space. Now, look, all I can do here is speak anecdotally based on what I'm seeing on the ground, but I spoke with 3 local coin shops this past week, and 2 of them said the type of silver that you had to sell determined if they'd even be willing to buy it. Now, let that sink in for a second because it gets worse. All 3 were willing to buy American Silver Eagles, but none of them would even pay spot. And you can't really blame them because the volatility in silver right now means they're taking a lot of risk holding unplanned inventory that could really go either direction in price. So if you're buying silver for profit and you're waiting for that perfect time to sell, it's just not logical to think that it's also going to be the perfect time for the local coin shop to buy. So I was given buyback offers of $10 or even $11 below spot for generic rounds or silver bars. That was if they were willing to buy at all. Now, of course, your mileage will vary, but at this point, outside of a few props, I really only have American Silver Eagles. So that's what I was most interested in. And one dealer said he would give me spot. Now, that was someone I knew well. If I remember right, spot was right around $78 that day. The other 2 said $75. So $3 under for American Silver Eagles. Now, gold was a little bit different, which makes sense. Gold price swings have not been as violent as silver's, but the local dealers, no surprise, weren't willing to give me spot for anything other than a buffalo or a gold eagle. So these series coins, which should all have some extra premium, meant nothing to the local shops, actually less than nothing. Now, in the case of a U.S. Mint commemorative, most of the shops, again, I was only talking to 3, but 2 of them said they would give me the same as a buffalo or eagle. Now, the exception there, of course, is the Mustang. But remember, the Mustang is going for $20,000 on eBay. So last thing I'm going to do is bring that into a local shop. Now, I've been jumping around here between gold and silver when really the two are very different. Can't say that enough. But if you're like me with the ultimate goal of saving in gold, then your silver comes with a decision on when to sell, when to swap, and I would say a decision at the outset of what to buy to begin with. Because if an American Silver Eagle costs you $10 more per ounce than, say, a generic round, well, you come out even in terms of the buy to sell spread with the 3 dealers I spoke to. Again, I realize that's a small sample, but 2 of those dealers didn't really even want generic silver at all. That's regardless of price. So this is why I've been saying that you need to identify the purpose and act accordingly. Purpose just being, are you holding or are you trading? You need to know the dog's name to call it home. Now, if you're buying silver to swap to gold at the best possible moment, you better be doing it at a level that you're able to ship. Or if you're wanting to do it locally, you better have the type of silver that your local dealer is willing to buy. Now, if you're holding, you're giving up that ideal time to exit, but you're also avoiding some of these current conditions that are making it hard to sell. So these decisions are either extremely important if you're watching price, you're looking for profit, or they're barely important at all if you just don't care where we are in the cycle. Now, I'm not making any kind of recommendation on what you should do, but my next big move with physical silver will be a sale. I'm going to be trading silver, holding gold. And because the type of physical silver that I have is American Silver Eagles and Mint tubes, I have all kinds of options. I can easily ship them to someone like Summit Metals. I can sell them to a local shop, or I can find a private buyer. And I knew that when I bought them. I knew I was planning to trade them for a profit. So I bought the easiest form of silver to sell quickly. Because I'm still timing this, even though I could profit today. I think I bought those Silver Eagles in late 2024 for $30 an ounce all in. Now, if you're thinking the same, if you're planning for a profit, planning for a trade, and you have generic bars and rounds and other curiosities, you're going to need more time than that. You're going to need more planning. And I would recommend that you start in on that now. Even if you think like I do that this rally still has a lot of room to run, you're going to need to plan. Now, like I said, none of this is to say that I think the music is about to end. Physical metal just makes a more awkward trade. I've been bullish enough on silver short-term potential that I'm also trading it on the brokerage platforms. And really, there's no trouble there at all. And there's no confusion on what that's for. And we don't need to overcomplicate any of this. I would just say that if you do intend to sell at some point, do yourself a favor. Just reach out to a local dealer, email Summit Metals. Just ask about logistics, get a bid price, figure out what you need to do. And that's really just about knowing the exit, but don't let that put you off continuing to accumulate, because even though the least sexy thing that we can talk about here is just your typical scheduled purchases, something like fractional American Gold Eagle every month, that plan to just keep buying is still very likely to become the most significant part of your long-term holdings. And let's call it good there. Let us know how you're playing this. Are you planning to take some profit off the table? Are you planning to swap some silver for gold? Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.
Unlock the future of fiduciary operations with JusticeFund, the digital platform that reshapes judgment claims and bills of exchange into efficient digital workflow. Experience advanced claim management with automated workflows, real-time updates, and secure exchange processing. Stay ahead with comprehensive compliance and reporting tools enhanced by military-grade multi-factor authentication and end-to-end encryption. Enjoy peace of mind with our platform's 99.9% uptime and record of zero security breaches. JusticeFund seamlessly integrates into your existing technology, slashing processing time by up to 70% and cutting operational costs by 65%. Benefit from customizable dashboards, advanced analytics, and dedicated support tailored for fiduciary professionals. Rest assured knowing that JusticeFund guarantees compliance with federal, state, and international regulations. Join the revolution in fiduciary management today with JusticeFund, your partner in efficiency and security. Master the future of legal transactions with JFE Notary Chain and turn innovation into your competitive edge. Get started with the standard plan at $1,999, limited time $1,599, and unlock full curriculum access, a digital certificate, our community forum, and 3 months of instructor support. Build foundational expertise that gets you career entry-level ready faster and with confidence. Go further with premium at $2,999, limited time $2,399, including all standard features plus 6 months extended support, 2x one-on-one mentoring sessions, access to advanced workshops, and an alumni network invite. Enjoy accelerated learning, personalized guidance, and enhanced networking to stand out in the market. Scale with our corporate solutions featuring a tailored curriculum, dedicated corporate training, bulk enrollment discounts, and white label options. Equip teams with scalable training and give your organization a decisive strategic advantage. Enroll now and join a future-focused community mastering JFE Notary